In the history of sovereign finance, debt crises rarely materialize abruptly. They emerge gradually, quietly, through compounding structural imbalances that remain hidden until the system reaches a tipping point. Today, the United States, once the uncontested anchor of global financial stability, is approaching such a threshold. With federal deficits entrenched, interest payments skyrocketing, and entitlement obligations expanding at exponential rates, America is on course to cross $50 trillion in federal debt before the decade closes. This is not a distant theoretical concern. It is a mathematical certainty. The real question is not if the U.S. reaches $50 trillion in debt, but what happens when it does, to bond markets, to global liquidity, to inflation, to geopolitical stability, and to the institutional credibility of the world's reserve currency issuer. To understand the dynamics driving the U.S. toward a debt spiral, we must examine 5 interconnected forces: structural fiscal deficits, rising interest costs, demographic pressures, political gridlock, and the fragility of the dollar-centric global order. Each of these factors is terrifying on its own. Together, they constitute the architecture of a looming fiscal inflection point. The U.S. federal government has entered a regime of structural fiscal deficits, chronic gaps between spending and revenue that persist even during periods of economic expansion. In classical macroeconomic theory, deficits are meant to be cyclical, widening during recessions and narrowing during recoveries. But since the early 2000s, the U.S. has violated this pattern. The deficit remains elevated across all phases of the business cycle, reflecting not temporary stabilization policies but embedded structural overspending. Several long-term forces drive this imbalanced mandatory spending dominance. Social Security, Medicare, Medicaid, and other automatic spending programs consume over 60% of the federal budget and grow independent of congressional action. Underfunded tax base, federal tax receipts average roughly 17 to 18% of GDP, but spending continues to trend above 23% of GDP. Defense and geopolitical commitments, military expenditures remain high due to global force projection, proxy conflicts, and geopolitical competition with China. Inelastic political demand for services. Neither political party has incentive to meaningfully reduce spending. The result is a fiscal trajectory in which deficits remain between $1.5 to $2 trillion per year, even in periods of economic strength. At current growth rates, the Congressional Budget Office estimates U.S. debt could exceed $50 trillion by 2033, a figure many analysts consider conservative due to optimistic growth and interest rate assumptions. Structural deficits represent the engine of the debt spiral, always running, impossible to switch off, and constantly feeding the compounding mechanism of sovereign indebtedness. If structural deficits are the engine, interest payments are the accelerant. As debt grows, the cost of servicing that debt rises at an even faster rate, especially in a higher interest rate environment. This phenomenon, known as the debt snowball effect, occurs when the effective interest rate on debt exceeds the economy's growth rate. For years, the U.S. escaped this fate thanks to zero interest rate policy, ZIRP, quantitative easing, QE, foreign central bank demand for treasuries, low global inflation, but that era is over. The interest shock. Between 2022 and 2024, the Federal Reserve delivered the most aggressive tightening cycle since the early 1980s. Treasury yields surged, and the U.S. government now borrows at rates 300 to 500 basis points higher than during the QE decade. As a result, interest costs now exceed $1 trillion per year. Interest payments surpass the defense budget. Interest is projected to become the largest line item in the federal budget by 2027. Net interest as a share of GDP is the highest since World War II. When the U.S. crosses $50 trillion in debt, interest payments could exceed $2 trillion annually, creating a vicious cycle: higher debt, higher interest payments, higher deficits, more borrowing, even higher interest payments. This is the textbook definition of a sovereign debt spiral. Unlike households or corporations, the U.S. cannot default involuntarily, but it can default functionally, through inflation, financial repression, or currency debasement. The interest cost explosion is the clearest signal yet that the U.S. fiscal trajectory has passed from concerning to unsustainable. The next major force in the U.S. debt spiral is demographic. America is aging rapidly. As baby boomers retire, entitlement obligations expand at a pace far exceeding the growth of the tax base. Social Security and Medicare are both structurally underfunded and face insolvency windows within the next decade. The fiscal impact of aging. 3 demographic factors drive debt expansion. Higher entitlement spending. Older populations demand more health care, pensions, disability benefits, and long-term care. These expenditures grow automatically through cost of living adjustments and medical inflation. Shrinking worker to retiree ratio. Fewer workers support more retirees, weakening payroll tax revenue, the primary funding source for Social Security and Medicare. Lower consumption elasticity. Older populations spend less, depressing economic growth and tax receipts. The demographic trajectory is clear. The number of Americans over 65 will double from 2010 to 2035. Medicare spending is projected to rise from 3% to 6% of GDP. Social Security will exceed 6% of GDP. Disability and long-term care expenditures will grow exponentially. Demographics are destiny and fiscal policy, and in the United States, they are pushing the nation towards structurally higher deficits and debt. A sovereign debt crisis is not purely economic, it is political. The US political system is structurally incapable of solving long-term fiscal issues due to partisan gridlock, polarization, touch the third rail entitlement politics, short-term electoral incentives, no constituency for fiscal austerity, reluctance to raise taxes or cut spending. In the 1990s, bipartisan cooperation allowed for fiscal consolidation. Today, such cooperation is nearly unimaginable. Every fiscal stabilization tool is politically toxic, raising the retirement age, reforming Medicare, reforming Social Security, capping discretionary spending, implementing value-added tax or carbon taxes, cutting defense spending. The political system is built to avoid pain, defer costs, and delay structural reforms. As a result, the debt continues to expand mechanically without intervention year after year. Political paralysis guarantees that the US will continue moving toward the $50 trillion level with no meaningful adjustments. The final dimension of the debt spiral is international. The US dollar is the world's reserve currency, giving America an unparalleled advantage: the ability to borrow in its own currency at scale. This privilege allows the US to run large fiscal and current account deficits without triggering immediate financial crises, a phenomenon known as the exorbitant privilege. But reserve currency status is not unbreakable. Multiple geopolitical and economic trends challenge the sustainability of the dollar-centric global order. Gradual diversification of foreign exchange reserves, rising US-China strategic rivalry, growing use of local currency settlement blocks, energy exporters exploring non-dollar pricing, declining foreign demand for US treasuries, rising weaponization of financial sanctions. Foreign holdings of US treasuries as a share of total debt have been declining for over a decade, forcing domestic institutions, banks, pension funds, money market funds, to absorb more issuance. This increases the vulnerability of the treasury market, the backbone of global finance. If global investors lose confidence in US fiscal management, the consequences include higher term premiums, more volatile yield curves, lower reserve demand for treasuries, increased reliance on the Federal Reserve as a buyer of last resort. The US debt spiral is not only a domestic challenge, it is a systemic global risk. Assuming deficits continue at current levels or gets worse, US debt rises on autopilot. To illustrate how quickly the spiral compounds, consider the following debt math. Step 1, baseline deficit of approximately 7% of GDP. At a $28 trillion GDP, that is a $2 trillion annual deficit. Step 2, rising interest costs. As existing debt rolls over at higher rates, interest payments exceed $1.5 trillion within years. Step 3, debt compounds at an accelerating rate. Higher interest, larger deficits, more borrowing. Step 4, mandatory spending grows automatically. Social Security and Medicare increase both nominally and as share of GDP due to aging. Step 5, revenue remains stagnant. The tax base grows slower than expenditures due to demographics and productivity stagnation. Under these conditions, the US hits $40 trillion by 2029, $50 trillion by 2033, $60 trillion by 2037. By this point, interest payments alone may exceed all discretionary spending combined. This is the mathematical reality of the debt spiral. A US debt crisis will not resemble a typical emerging market default. The US controls its own currency, its own central bank, and its own legal frameworks. Instead, the crisis will manifest through indirect channels. Here are the most plausible resolution paths. Scenario A, financial repression. The US caps interest rates through the yield curve control, regulatory capital mandates, inflation above interest rates, forced domestic absorption of treasuries. This erodes real debt value over time. Scenario B, inflationary debt liquidation. The government allows moderate to high inflation, reducing the real value of outstanding liabilities. Historically, inflation is the preferred path for heavily indebted governments. Scenario C, sharp fiscal consolidation, politically unlikely. Entitlement reform, tax increases, and spending cuts stabilize debt. This is theoretically possible, but politically improbable before the crisis stage. Scenario D, disorderly bond market event. A buyer's strike in the treasury market forces the Fed to intervene with unlimited quantitative easing, triggering inflation or currency volatility. This would mark a loss of market confidence in US fiscal sustainability. Conclusion, the uncomfortable truth of the $50 trillion era. The United States is entering a fiscal regime without historical precedent. The combination of structural deficits, exploding interest costs, aging demographics, political paralysis, weakening global demand for treasuries, an overstretched reserve currency system creates a sovereign debt trajectory that is fundamentally unsustainable. The US is not at risk of an imminent default. The real risk is gradual fiscal deterioration leading to instability in the bond market, persistent inflation, higher risk premiums, and a long-term erosion of economic dominance. The world is entering the age of the American debt spiral, and spirals, by their very nature, do not unwind easily. If you want to stay ahead of what's really happening in global macroeconomics, financial markets, and geopolitical risk, this channel breaks it all down in a clear and simple way. Make sure to subscribe so you never miss the trends, warnings, and insights shaping the economy before everyone else sees them.